In a significant development for the cryptocurrency landscape, Robinhood has announced that the Securities and Exchange Commission (SEC) has officially closed its investigation into the company's crypto unit without pursuing any enforcement action. This revelation, made public on February 24, 2025, is seen as a potential turning point in the regulatory environment for crypto businesses in the United States. The SEC's decision to drop its investigation follows a similar move concerning Coinbase, which had recently received notice that the SEC was dismissing a lawsuit against it as well. Robinhood disclosed that it received a letter from the SEC's Enforcement Division indicating that the agency would not pursue any penalties related to its cryptocurrency operations. This news initially caused Robinhood's stock to rise, although it later fell back amid broader market trends. Robinhood had been under scrutiny since May 2024, when the SEC issued a Wells notice indicating that the company might face charges for alleged violations of securities law. The SEC's investigation focused on various aspects of Robinhood's crypto activities, including its listings, custody practices, and platform operations. Dan Gallagher, Robinhood's chief legal officer, expressed relief at the closure of the investigation, stating, "Robinhood Crypto always has and will always respect federal securities laws and never allow transactions in securities." The SEC's actions are reflective of a broader shift in the regulatory approach to cryptocurrencies, especially as the political landscape evolves. Following a tumultuous period under former SEC Chair Gary Gensler, who was often criticized for a stringent enforcement strategy, there are growing expectations that the incoming administration under President Donald Trump may adopt a more lenient stance towards crypto regulation. Trump's election has rekindled optimism among industry stakeholders, with many hopeful for clearer regulations that would foster innovation and growth. Robinhood's crypto segment has proven to be a lucrative venture, contributing nearly half of the company's transaction-based revenue in the last quarter of 2024. With Bitcoin recently nearing the $100,000 threshold driven by speculation around favorable regulatory changes, the company is poised to benefit significantly from the evolving market conditions. The cryptocurrency industry is bracing for potential legislative changes that could further reshape the landscape. As Robinhood and other firms await more definitive regulatory guidelines, the focus remains on how these developments will influence market dynamics, investor sentiment, and the broader acceptance of cryptocurrencies as a legitimate asset class. The coming months may prove crucial as the SEC under new leadership begins to define its stance toward an industry that has shown resilience and adaptability in the face of regulatory challenges. In a critical moment for the cryptocurrency landscape, innovative initiatives and legislative developments are reshaping the future of digital assets. As major players like Rezolve AI and Tether forge ahead with cutting-edge strategies and state-level Bitcoin reserve bills face intense scrutiny, the implications for the crypto economy are profound. Rezolve AI, a leader in AI-driven commerce solutions, has made headlines with its announcement of a groundbreaking $1 billion Bitcoin treasury program. Launched on February 24, 2025, this ambitious initiative begins with an initial investment of $100 million, signaling the company's commitment to integrating artificial intelligence, blockchain technology, and cryptocurrency in mainstream commerce. Daniel M. Wagner, CEO of Rezolve AI, stated, "This is more than an investment, it's a statement of intent. We're not just embracing the future of finance, we're building it." The Bitcoin treasury is intended to support the commercialization of Rezolve AI's upcoming crypto payment platform, which will allow seamless transactions using Bitcoin, Tether, and other digital assets. This move positions Rezolve AI at the forefront of the digital asset revolution, aiming to empower consumers and retailers alike. Wagner emphasized the importance of Bitcoin in this strategy, citing its status as the world's most trusted cryptocurrency and a hedge against inflation. By holding Bitcoin, Rezolve AI aligns itself with the future of money, ensuring it remains at the forefront of the digital economy, he added. However, not all news in the cryptocurrency sector is met with optimism. In the United States, 3 bills proposing state-run Bitcoin reserves have failed despite the national push for more pro-crypto legislation under President Donald Trump. Lawmakers in states like Montana, North Dakota, and Wyoming have expressed concerns regarding the risks and speculative nature of such reserves. "This just smacks of speculation," said Montana Representative Stephen Kelly, reflecting the sentiment among detractors who worry about the potential jeopardization of taxpayer funds. Despite these setbacks, states like Utah and Arizona are moving forward with their own initiatives. Utah's proposed bill would allow a portion of state funds to be invested in digital assets, while Arizona is advancing the Strategic Bitcoin Reserve Act. This legislation, if passed, would enable the state to allocate up to 10% of public funds, including pension funds, into Bitcoin, signaling a cautious yet progressive approach to crypto integration. The overall market reaction to these developments has been mixed. Bitcoin's price has stabilized around $95,850, while Ethereum has seen a decline of approximately 4.6%. As states and corporations navigate the complex regulatory landscape and market volatility, the broader implications for the adoption of cryptocurrencies remain uncertain. As the cryptocurrency sector continues to evolve, the interplay between corporate initiatives like those of Rezolve AI and state-level legislative actions will be vital in shaping its future. The commitment to integrating digital assets into everyday transactions could pave the way for a more decentralized financial ecosystem. In this rapidly changing landscape, the coming months will be crucial in determining whether these ambitious visions can translate into sustainable growth and acceptance in the global marketplace. In a striking turn of events, 3 proposed bills aimed at establishing state-run Bitcoin reserves have met resounding defeat across several U.S. states. Despite the renewed optimism surrounding cryptocurrency fostered by the recent election of Donald Trump. While Trump has positioned himself as a champion of crypto, promising to make the U.S. the crypto capital of the planet and appointing a crypto czar, state lawmakers have raised serious concerns about the speculative nature and risks associated with investing public funds in digital assets. As the cryptocurrency landscape evolves, states like Montana, North Dakota, and Wyoming have squashed bills that would have allocated taxpayer money to Bitcoin reserves. In Montana, for instance, House Bill 429, which aimed to create a special revenue account for investing in precious metals and digital assets, was voted down with a disappointing 41 in favor and 59 against. North Dakota's HB 1184 also faced a similar fate, narrowly defeated by a 57-32 vote. Even in Wyoming, a state closely associated with cryptocurrency advocacy, 7 out of 9 representatives rejected a measure to authorize the state treasurer to invest public funds in Bitcoin. The backlash from lawmakers isn't just a product of skepticism. They warn that such speculative ventures jeopardize taxpayer money. "This just smacks of speculation," remarked Montana Representative Stephen Kelly, echoing a sentiment shared by many of his colleagues. Despite these setbacks, over 30 states are actively exploring legislation concerning Bitcoin reserves and digital asset investments, indicating a complex and evolving dialogue surrounding the future of cryptocurrency in the U.S. Interestingly, the political climate has shifted noticeably since Trump took office. Anthony Scaramucci, a crypto investor and hedge fund manager, underscored the urgency felt by lawmakers after Trump's inauguration, stating, "Donald Trump was sworn in at noon on January 20, and at 12:01 everyone wanted a Bitcoin strategic reserve. This reflects a broader trend in which pro-crypto sentiment is seen as a potential vote-winning strategy despite the practical challenges of implementation. Notably, not all states are retreating. Utah is on the verge of passing legislation that would permit up to 5% of major state funds to be invested in qualifying digital assets. Meanwhile, Arizona's Strategic Bitcoin Reserve Act is gaining traction, recently passing the Senate Finance Committee and poised for further debate in the Senate Rules Committee. If approved, Arizona could allow up to 10% of state and public funds, including pension funds, to be allocated to Bitcoin investments. As the cryptocurrency market remains volatile, Bitcoin has stabilized at around $95,850, while Ethereum has seen a slight decline, trading at $2,680. The broader implications of these legislative moves are significant. as they not only reflect changing attitudes toward digital assets but also signal the potential for future institutional investment. In a related development, EDX Markets, a crypto exchange backed by major Wall Street firms, has announced the addition of 17 new cryptocurrencies including XRP and Trump Coin to its platform. This expansion reflects a growing institutional interest in crypto, particularly as the market seeks to recover from previous downturns. EDX Markets CEO Tony Akunaroda expressed optimism about the exchange's readiness to accommodate this influx of traditional financial clients, stating, "This is the moment we've been waiting for." The ongoing discourse surrounding cryptocurrency legislation at the state level, coupled with the increasing acceptance of digital assets among financial institutions, suggests a transformative period ahead for the crypto landscape in the U.S., as states like Utah and Arizona make strides while others falter. The trajectory of Bitcoin and its peers will likely remain a focal point for both investors and policymakers in the years to come. The question remains, how will this evolving regulatory environment shape the future of cryptocurrency in America? As we look ahead, the interplay between legislative developments and market dynamics will be crucial. The potential for states to embrace or reject cryptocurrency investments will undoubtedly influence both local economies and the broader financial ecosystem. The commitment to exploring digital assets even amid setbacks indicates that while the path may be fraught with challenges, the journey toward a more integrated and accepted crypto framework is only just beginning. In a shocking turn of events for the cryptocurrency world, Bybit, a prominent digital asset exchange, recently fell victim to a massive hack amounting to $1.4 billion. This unprecedented breach not only raised alarms across the industry but has also sparked a surprising resurgence in Ethereum ETH reserves on the platform, hinting at a potential silver lining for the beleaguered cryptocurrency. The hack, which targeted Bybit's cold wallet, an offline storage solution designed to safeguard digital assets, has been described as the largest exploit in the history of cryptocurrency exchanges. Following the incident, market intelligence firm CryptoQuant reported on February 24, 2025 that Bybit is witnessing a steady recovery of its ETH reserves. Julio Moreno, the head of research at CryptoQuant, revealed that the exchange has experienced positive inflows of over $390 million in ETH since the hack, with net flows of approximately 139,000 ETH. Moreno noted on the social media platform X, Bybit's ETH reserves are slowly recovering. The exchange has experienced positive net flows since the hack, underscoring the resilience of the platform amidst the turmoil. The recovery appears to be driven by a combination of loans and deposits from other digital asset firms and significant crypto investors or whales. According to recent data from blockchain tracker Lukenchain, Bybit has received substantial support from various sources. Notably, whales have transferred significant amounts of ETH from other exchanges such as Binance and BitGet as loans to help bolster Bybit's liquidity. In total, Bybit has received 145,879 ETH valued at $390 million, which comprises funds from multiple significant transactions, including a notable loan from Fenbushi Capital and various other whale deposits. As Ethereum trades at approximately $2,808, this influx of capital is seen as a critical lifeline for Bybit, helping to stabilize its operations in the wake of such a devastating cyber attack. The broader implications of the hack, however, extend beyond Bybit's immediate recovery. Industry observers suggest that this incident could lead to increased scrutiny and regulatory attention towards crypto exchanges, potentially reshaping how digital assets are managed and secured. Moreover, the hack comes at a critical time for the cryptocurrency market, which is grappling with volatility and regulatory challenges. The Federal Reserve's recent warnings about economic conditions, particularly concerns over inflation and potential stagflation, have added further uncertainty. This has led to a cautious atmosphere among investors as they weigh the implications of macroeconomic factors against the backdrop of the ongoing crypto crisis. In the wake of the Bybit hack, Bitcoin and other cryptocurrencies have experienced fluctuations in their market prices, with fears of potential suppression lingering. As noted in reports from Forbes, the cryptocurrency market is currently in a state of flux, with significant legislative updates expected that could influence future price movements. The ongoing discussions around Bitcoin exchange-traded funds, ETFs, and institutional inflows offer a glimmer of hope for market recovery. As the cryptocurrency community watches closely, the events surrounding Bybit serve as a stark reminder of the inherent risks in the digital asset space. The mixed outcomes, an industry-wide alarm over security vulnerabilities, yet a potential rebound for Ethereum, highlight the unpredictable nature of the market. Looking ahead, stakeholders will be keen to observe how Bybit navigates this crisis and whether it can leverage this moment to strengthen its infrastructure and regain user trust. The unfolding situation will undoubtedly shape the future landscape of cryptocurrency exchanges and their operational protocols. In a dramatic turn of events, the cryptocurrency market is witnessing significant turbulence, particularly for Solana SOL, which has experienced a staggering 35% decline amid escalating selling pressure linked to the FTX estate unlock. As the cryptocurrency landscape continues to evolve, this downturn raises questions about the future stability and viability of prominent blockchain networks, particularly as they navigate the ramifications of risky financial maneuvers and the ongoing fallout from memecoin controversies. Solana's recent struggles can be traced back to a confluence of factors, including a broader market correction and the surge of controversial memecoins that once fueled its growth. The digital asset, which had previously enjoyed a meteoric rise, has seen its value plummet by over 37% in the past month alone, outpacing declines seen in other major cryptocurrencies such as Ethereum. Analysts attribute this downturn to the negative publicity surrounding high-profile memecoin launches, particularly the Libra memecoin, which was promoted by Argentine President Javier Milei. Following its crash shortly after launch, outrage ensued, tarnishing Solana's reputation as a reliable platform for innovative projects. Carlos Guzman, an analyst at market-making firm GSR, remains cautiously optimistic about Solana's prospects. He notes that despite the challenges posed by the memecoin debacle, there are still promising developments on the horizon, including potential regulatory clarity and the possibility of a SOL ETF which could restore investor confidence. There are additional reasons to be optimistic about Solana, Guzman stated, highlighting the network's diverse applications in payments, decentralized finance, DeFi, and artificial intelligence. However, the criticisms leveled against Solana are not unfounded. The network's heavy reliance on platforms such as Pump.Fun, which facilitates the easy launch of memecoins, has drawn scrutiny. As a result, many investors are feeling the impact of the cascading losses associated with these speculative assets. Research from Nansen indicated that over 86% of wallets that invested in Milei's memecoin suffered significant losses. Ivan, a co-founder of the DeFi project Gearbox Protocol, remarked, "A permissionless market is one thing, but validating scams kills the other asset classes," underscoring the detrimental effects of these volatile and often predatory financial products. In response to the unfolding crisis, Solana's leadership is taking steps to regain control. Mert Mumtaz, CEO of Solana developer platform Helios, announced the hiring of a forensic researcher to combat fraudulent activities in the wake of the Libra incident. Meanwhile, Brian Armstrong, CEO of Coinbase, called for a purge of bad actors in the cryptocurrency space, emphasizing the need for the industry to self-regulate and protect its integrity. Despite the current turmoil, some industry experts argue that claims of Solana's demise are exaggerated. Guzman asserts that the memecoin frenzy is a temporary phenomenon, noting that memecoin mania would eventually die down given its zero-sum nature and the fact that most participants lose money. This sentiment reflects a broader belief that while the market is facing a significant reckoning, the underlying technology and potential of blockchain platforms like Solana remain intact. As the cryptocurrency sector grapples with these challenges, it is clear that the path forward will require both resilience and adaptation. The coming weeks and months will be crucial as stakeholders seek to navigate this complex landscape, and the outcomes of current regulatory discussions may play a pivotal role in shaping the future of cryptocurrencies. Investors and enthusiasts alike will be watching closely to see how Solana and its peers respond to the ongoing pressures, with the hope that innovation and stability can ultimately triumph over adversity.